Well, welcome to the Economist Board for our February 2025 Watch Report. I'm John Nelson from M&A, and I'm joined today by Keith Prather of Armada. And in these videos, we're going to provide some additional context to the narratives of what's going on, what you've seen in the watch. And then we're also going to, in this specific video that we're kicking off the series with, is we're going to focus on overall industrial production for manufacturing. For our subscribers, I've seen those of you that look at these industrial production videos. If you're a subscriber, you get to look deeper. You get to look at individual videos covering sectors, subsectors of industrial production, as well as transportation of goods, the construction sector, the macroeconomic sector. And Keith, I haven't let you talk yet, but one of the interesting thing that I saw is I usually say that we take a look at retail spending because it's about 70% of GDP. But I saw an article in the Wall Street Journal this last week that in an unusual turn, it was up to almost 80%.
Yeah, absolutely. In Q4, that's what we found. It contributed 82% of GDP. And yeah, so consumer spending was really strong. Now, if you go look at the macroeconomic presentation, the video, go check it out because we got a turn. And that turn is not a good one. And we're trying to figure out whether it's a Q1 anomaly, maybe even a January anomaly. We had a combination of weather. We had a lot of things impacting the world. We also had a transition in administrations, and there's been a lot of things kind of taking place in the Trump administration. But we've got to figure out whether short term or not, and the value of the models and the value of the reason why we do this is that the statistical and data driven nature of all the models like IPMAN help us see through the smoke, the fog, the mirrors, all those things that throw us daily curveballs and help us understand what the real underlying fundamentals look like. So I think that'll be the value, but check out that other video if you have a chance.
Yeah. So there you go, folks. If you are not a subscriber, that's your shameless plug for the reason why you need to become a subscriber. And if you are a subscriber and you haven't been looking at the macroeconomic one, that's a teaser for this month. You really do, because it's not the garden variety discussion today. So anyway, with all that, we're going to get right into it. Keith, you ready to hit IPMAN?
Let's roll.
Okay, so let me find the share button, which always likes to conveniently hide itself.
It does. They've updated and things have moved.
Oh my gosh, where did they put it now? There it is.
Okay, you got it.
There we go. Okay, so this is our model for this month, and we always like to talk about data, and Keith, you talk about how consistent the data is. This is a case where data is pretty consistent. You're seeing a little bit of a rise, but you're also seeing softening in the IPMAN sector from what it was, and softening is kind of relative. Talking a point of softening because of the scale of this model. If you look, it's the scale on the right is 94 to 108. So that difference between last month and this month is just a point. It's well within the cone of variability that we talk about. And but what you are seeing is a little softer of a rise coming up. But again, we're still showing a little bit of growth in industrial production for the next few months. And if we take a look at the long-term trend, we're still above that 20-year trend. And it looks strong. Even if it comes down another several points, it still would be pretty strong relatively to the 20-year trend.
Yeah, I'm having a lot of discussions around the country. It doesn't matter what group I'm in front of. We're talking about what's happening in the U.S. economy, and manufacturing is always kind of top of the list. So we're getting a couple different signals. Our model here, if you look at that, John, it shows that, primarily by the end of the year, we should have a manufacturing sector that's maybe as strong as we've seen since going all the way back to 2018, 2019. A lot of this has nothing to do with the Trump administration right now, and we're going to remain bipartisan, right? That's our objective. our objective with Armada and with M&A is to be business focused, business centric, and what's good for business is generally the way we like to roll. Um, so this doesn't have anything to do with the Trump administration so much as it has to do with that business inventory cycle that we've talked about. We were coming out of that in 2014 through 2016, and so then you see that surge in manufacturing as we recover and restock inventories coming out of a destocking period. And that's kind of what we're getting now is that signal that you got that restocking period coming up in the second half of the year. We're already getting some pretty good manufacturing signals, I would say the best way to say it, out of the monthly PMI measures. So the Purchasing
Mm,
Managers Indexes in February gave us some really strong signals. The S&P Global PMI rose to about 52 points, a little over 52, which is an expanding manufacturing sector. And John, what we're worried about or overall concerned about is that we're concerned that a lot of manufacturers may have pulled forward future orders in order to get in ahead of tariffs. And I know that sounds odd because we're talking about domestic manufacturing, which you wouldn't think would be impacted by that pulled forward notion. But the challenge is that a lot of US manufacturers feed other supply chains. So we're building component parts that go feed like a Mexican assembly line, and then, a bigger, larger component then comes back to the US for final assembly. And a lot of manufacturers were trying to get ahead of potential tariffs. So we're sending those components and building those components in January and February to send them overseas so they can come back in time to beat the tariffs. And so you had a little bit of that, and we don't know what percentage that is of overall sales, but we're a little bit concerned that then when we see real manufacturing data coming in March and April, that it may show some of that pulled forward activity that should have been showing up in Q2, but we pulled it forward into Q1, fulfilled those new orders, delivered those products, and then we don't need as much in Q2. So that's the signal we're watching. Now, our model right now, which I was looking over here, the reason why I was over here is I was looking at the percent accuracy rate. We're about 97% accurate 6 months out on this model right now. So we've got a lot of confidence in what it's showing us over the next 6 months, and it is still showing a good steady growth curve headed through to basically the second half of the year. Um, the last thing I would say, John, is we have the cone of variability that you showed on the first slide, and
sure.
that cone still has a little bit of volatility in it. If you look at the downside risk of the model, it's still giving us the potential for a pretty good downside curve. So we'll see what happens. You and I talked off camera about the impact of some of the things happening with the Trump administration, the Department of Government Efficiency, and trimming government workers. We know there's a sort of a trickle through of a layoff of a government worker impacting maybe 2 to 3 jobs in the private sector, and just as suppliers get rolled up and get impacted by those trimming and that cut. And so we may see a little bit of deceleration coming out of this, but most people believe it's short-lived. I'm only bringing that up because we would consider those to be almost black swan events, John, where they're unexpected in the sense that we kind of know they're coming, but economically, it's a point in time where a big event happens and then it changes the economic environment afterwards pretty fundamentally.
Yeah.
And so the models don't have a lot of that built into them, but they do measure metrics that will pick that up, and they'll pick up the impact of that. So, what may be happening with Doge is real time. The models will pick it up within that next 30-day cycle much earlier than what you're going to see in other types of measures that try to measure this and understand it. But we'll continue to update it. And I'm only saying this because we still have a lot of confidence in the data-driven approach and what the models are showing us for now. There's no reason to back off of these forecasts and to think that for some reason they're not gonna pan out this way. Again, when we get the March update, at the end of the month, and then we kind of roll that out in early April. If there's pressure out there, you'll see the back end of these curves start to soften and start to flatten out,
Hmm.
and that's what we'll be watching. So
Okay.
there's a
Well,
lot
let's take a,
there. I
yeah,
apologize.
there's a lot in there.
Yeah.
let's go ahead and take a look at primary metals. So we can take a look at the supply chain all the way back at the source zone here. And again, this is showing the kind of that same little bit of softening, but still fairly strong. It's more softening on the far back end of it than it is on the next 6 months, pretty much kind of the same story. Again, a pretty wide cone of variability on some of these. But when you look at the accuracy, the cone says, well, these knuckleheads are going to be fine if it's anywhere within the cone. And what we're saying is if we're 97% accurate, we're going to be about 3 points off of this. So what that really means, and I don't remember the exact accuracy on that one, but with IPMAN, it was 3 points. This one's what? Probably close to that, right?
This one's 97%.
97%. So the same 3 points. 3 points difference on this one would be the difference from about here to, let's see if it's going to mark for me, from there to there.
Yeah.
So if in 6 months we're there, now you know what we're talking about how different we kind of expect it to be.
Right.
So
right.
I'm going to go ahead, I'm going to jump one slide. I'll erase that little mark because it's good. Oh, there you go. It erased itself. So here we go. The long-term look, primary metals long-term, we've got this kind of short-term positive aspect of it. 18 months, we're back on trend though.
Yeah, and I'm going to contradict myself from what I said earlier on, because this could be the one model and the one product line that maybe has the biggest unexpected impact from what we see with Doge and with tariffs and what the Trump administration is pushing, because what he would love to do is see the primary metal industry, so steel, aluminum, production of those metals move back to the United States. And John, this is a perfect illustration of what he's trying to counteract. Look at that long-term trend line. That long-term trend line is sort of the slow sleigh ride to hell, right? That we joke about. But that is basically a model, or this line, this trend is showing you the offshoring trend. That's what this is. U.S. manufacturing and production is up, right? We're seeing more production than we have historically, but primary metal production, where we're getting those primary metal inputs into the manufacturing process, is being offshored. And so to try and protect that industry, obviously he's applying 25% tariffs to steel and aluminum manufacturing. So that could reverse this chart. This thing may see the biggest volatility in the coming months. And I say coming months, it may take years for it to show up, for the impact of the tariffs to start moving more primary metal production back onto the US domestic market. But we would expect that line to start to flatten out and maybe even start to reverse course and start to increase over the next couple of years. Yeah, we're just not obviously getting those signals just yet.
Okay, so let's take a look at fabricated, which is a little closer in. Tells a little bit of a different story, kind of mirrors much more what you're seeing with industrial production itself, kind of that slow, gentle, increase over the last couple months. Again, the same story as what I showed you with IPMAN, what I showed you with in terms of the talking point, a little softer. Again, by another point or so softer, all the way out at 18 months. And if you take a look at fabricated metal over the long term, this is actually a really good story right now. For the longest time, it kind of stagnated, even declined for the first couple of years following the recovery after COVID. And we're calling for somewhat of a reversal of that trend.
Yeah, John, you did something also that I love, because it makes sense from a business perspective. You moved, instead of us looking at a 1 month accuracy rate, we moved to like a 3 month average. And that's great, because a lot of companies now live and work a quarter ahead, and right now this model, 3 month average right now is batting like, it's 99.4% accurate. So we've got so much confidence in that first, 3 months, that moving average, and it's showing a good growth signal, at least for fab metals. And again, this industry feeds so many other industries. So everything from automotive, aerospace, machinery, all those other industries, these are the inputs into those sectors and that manufacturing. And so it's giving us a really good, again, strong signal and growth rates that would take fabricated metal production back up to levels that we saw again prior to the pandemic. And I think this is an area also, just like we said with primary metals, it's going to get a lot of reinforcement over the next couple of years. How quickly that happens, I'm not quite sure. And since this is the one video that we send out to everybody, I want to point out and remind folks that one of the things the Trump administration is doing is they're speeding up the permitting process on any new construction. So we were talking about natural gas power plants and building natural gas power plants, and typically the permitting process on those takes anywhere from 14 to 18 months. They believe that they can reduce that down to less than 6 months. So the actual production, you think about the fabricated metal that goes into just that kind of a facility or the primary metals that goes into that. We could be seeing shovels hitting dirt by Q4 based on that permitting process if they speed it up that fast. So we don't have to wait until a whole facility is finished. The construction sector may be producing output and growth
Mhm.
that these models will pick up by the end of the year. And it's already giving us a positive signal. I wouldn't be surprised if this thing doesn't adjust and even go higher than this, over the next several months when we start to see some of that real activity. So again, a lot of these policies don't be mistaken thinking that, it's going to take 4 or 5 years for us to see the impact from them. The whole Trump agenda is to speed this thing up so that in the first 2 years of his administration, we're really starting to see momentum get built in construction, manufacturing, all that activity, supply chain activity, to kind of feed it into the midterms. And so it's going to be interesting to see how this all plays out. But right now, most of it feels like it's going to be positive.
Okay. Well, that completes our look at the overall industrial production, well, for manufacturing side of that look for this report, and hope you stay tuned. We got some interesting for when you log in, we got some interesting videos ahead for the subscribers for the subsectors and hit that transportation sector and construction sector that we talked about.
Absolutely. All right, everyone, take care. We'll see you soon.